Welcome to today's lesson. So I'm going to be showing you how to account for assets. But before we start with accounting for assets, it's important to start by understanding the double entry system because this is the one we are going to be using in this lesson, most of it. So let us start by understanding what is double entry system. So in the introduction to financial accounting, you're supposed to study something known as the accounting principles and concepts. So double entry system is one of the accounting principles. According to the double entry, we say that every time you record a transaction, you are supposed to debit one account and credit another account. In total, you have two accounts. Every transaction affects at least two accounts. It can affect more, but it will affect at least two accounts. Or in other words, every transaction must have a debit entry in one account and a credit entry in another account. That is the double entry system, one of the accounting concepts and principles. So the reason for using the double entry system, it ensures that the accounting equation remains in balance. The accounting equation is the one we say that assets is equals to liabilities plus equity. So if you follow the double entry in all the workings, so you realize that your balance sheet or your statement of financial position will always balance. If you follow it keenly, it will help you to be balancing your statement of financial position. So when you're looking at the accounting for assets, and when you're applying the double entry system in the accounting for assets, so how do you know when you are supposed to debit the account and when you are supposed to credit the account? We have a summary here. This is classification of accounts for double entry purposes. All accounts can be classified into 5 types. In other words, all transactions involved in a business must affect one or more of these types of accounts. Number 1, we have assets. Number 2, liability. Number 3, capital. Number 4, income. Number 4, expenses. All transactions will be affecting these types of accounts. So what you just need to do is to ask yourself, in this transaction, are we dealing with an asset? Are we dealing with a liability? Are we dealing with the capital, income, or expense? So once you understand, you'll be able to know whether you are going to debit or credit. If you are dealing with an asset and the asset is increasing, for example, you are buying more assets in the business, that is increase. So increase in asset, you are supposed to debit the asset account. While decrease in asset, you are supposed to credit the asset account. When you buy an asset, open an asset account, debit the asset account. When you sell an asset, that is a decrease, credit the asset account. When you go to liabilities, when liabilities increase, for example, when you take a loan from bank, you are supposed to open a liability account and credit that account. When the liability decreases, for example, when you pay the loan you had taken, you are supposed to debit the liability account. When you increase capital in the business, when you bring more cash from your personal savings into the business, we call it capital. You are supposed to credit the capital account. When you withdraw capital in the business in form of goods, in form of cash, in form of asset, you take it away from the business for your own personal use, non-business uses. That one reduces your capital. You are supposed to debit the capital account. When you generate income, for example, when you sell goods, you are supposed to credit the income account. In this case, it is going to be the sales account. So sales account is an income account. That is why when we sell goods, we credit the sales account. Sometimes some of the goods you had sold to a customer might be returned to the business. The income has decreased, so you debit the income account. You had counted that you have received that income, but if the customer returns the goods, you are supposed to refund them, or you are supposed to reduce the amount they are supposed to pay you, so you debit the income account. For the expenses, increase in expenses, you are supposed to debit something like salaries and wages, electricity expense, bills such as water bills. Every time you incur those expenses, open an expense account, give it the name of the expense. If it is electricity, call it electricity account, then debit the amount. When the expense reduces, maybe you had been overcharged, the power company had overcharged you, so they have to reduce the expense. You are supposed to credit the expense account. So that is what we call the double entry. Every time you come across a transaction, ask yourself, does this transaction involve an asset or a liability, capital, income, or an expense? If, for example, it involves an asset, ask yourself, is the asset increasing or is the asset decreasing? It will help you to know whether you are going to debit or whether you are going to credit. And another thing, we have said that every transaction affects at least two accounts. So ask yourself, are those two accounts both assets account? Or is one of them an asset account and is the other one a liability account? For example, you bring money from your personal savings account into the business. Which two accounts will be affected? If you bring cash to the business, cash is an asset. Is the asset increasing? Yes, because you have brought cash into the business. So you debit cash account. And then what is happening to capital? You have brought cash from your personal savings into the business. Capital has increased. So what do we do when capital increases? You open a capital account, you credit. So you have debited cash, you have credited capital. The transaction has affected asset and the capital. And you have debited one and you have credited the other. If you take a loan from bank, ask yourself, which are the two accounts being affected? A loan from the bank, you're going to get cash. Cash is an asset. Cash is going to increase. So you will debit cash. Liabilities are also going to increase. So open a loan account, which is a liability account. Credit with the amount of loan you have taken. So that is how you can be able to know which account are you going to debit and which one you are going to credit. So now we want to focus on assets alone. And then in other lessons, we will be focusing on liabilities, the capital and all the others. But for this lesson, we are going to focus on assets alone. So what is an asset? An asset is anything valuable that a business owns or controls, which can bring future benefits or income to the business. Anything that has value and it belongs to the business, or the business has control over that asset. For example, a motor vehicle. If the motor vehicle belongs to the business, if the business has control over that motor vehicle, then that is an asset. It has value. It can bring benefit to the business because it will facilitate activities in the business. Assets can be of many types. We want to see some of those types here. The major classification of assets is current asset, number one, non-current assets or fixed assets, number two. Those two are the main classification of assets, because the other two, intangible assets and financial assets, those can also be classified as current. For example, the financial assets can be under current asset or under non-current asset. Intangible assets can also be classified under non-current assets. So the major categories of assets are two: current assets and non-current assets. So for the current assets, these are assets that are expected to be used up, sold, or converted into cash within 1 year. These assets don't stay in the business for more than 1 year. For example, you buy goods. You have bought goods intending to sell those goods to customers as soon as you get a customer. So that is a current asset. So you receive cash from the bank. The cash you have is a current asset. You don't have intentions of keeping that cash. You are going to spend it. So current assets, you don't have intentions of keeping them in the business for a period of 1 year. We have examples of current assets: cash, bank balance, debtors, accounts. So debtors and accounts receivables refer to the same thing: inventory or stock, prepaid expenses. If you sell goods on credit, we call that accounts receivable or debtor. You want the debtor to pay you as soon as possible. You don't want them to go a year without paying you. So it is a current asset because you expect payment within 1 year. So the non-current assets, also known as fixed assets, these are assets that the business uses for a long period of time, usually more than 1 year. Businesses have no intention of selling the fixed assets. It is not the same as the inventory which you buy intending to sell them as soon as you get a customer. Non-current assets, they help the business to operate, to run. For example, a machine helps the business to convert raw materials into finished goods. The business intends to keep it, to continue operating, to support its operating activities. So look at the examples of non-current assets. We have land and buildings, we have motor vehicles, office furniture, computers and equipment, machinery. These assets are the ones that the business keeps for more than 1 year, for many years. So that is non-current asset. We have intangible assets. These are non-physical assets that still have value and provide benefits. So keep in mind that intangible assets are examples of non-current assets. Examples include goodwill, patents, trademarks, and copyrights. So goodwill is the reputation a business has. When a business has a good reputation, that one can help to attract customers. So we say it has value to the business. Patents, these are exclusive rights to produce the product you have invented. If you invent a product right now, you are given exclusive rights. That means you are the only person allowed to produce that product. That is a patent. And you are given a patent when you invent something that is very new that others cannot be able to come up with. Trademarks, these are symbols, logos, names that identify your product or your business. A name like Samsung, a name like iPhone, those are trademarks. A name like Coca-Cola, it helps to identify the product of that company. And then we have copyrights. Copyrights protects creative works such as literature, books, novels. Copyright also protects music, videos, movies, documentaries, pictures. So those we call it copyright, and it has value because you can actually sell the copyright. You have written a book. Others are not supposed to copy your book and distribute it. But if they pay you, you can give them the right to copy your work and to sell it after they have paid you. So you can see that copyright has value. So it is an intangible asset. Lastly, we have financial assets, also known as investments. So these are assets that represent ownership in other businesses or returns from investment. Examples include shares in other companies, government bonds, long-term deposits. So if a business buys shares in another business, that is an investment. If a business buys treasury bills or treasury bonds that are issued by the government, that will be called an investment, which is a type of a financial asset. If a business deposits money in a bank, a fixed deposit account, we call that a long-term deposit. It is a financial asset. It is an investment. Financial assets, depending on the duration, they can be current assets. They can also be non-current assets. So those are the types of assets. Next, we want to know how to record assets using the double entry system. And we are going to start with asset acquisition. So when a business buys an asset for cash, what are the entries that you are supposed to make? In the beginning, we have seen that when an asset increases, you are supposed to debit the asset account. And when an asset is decreasing, you are supposed to credit the asset account. So you buy an asset and you pay cash. In this case, you will find that there are two assets involved. The asset you are buying, let's say you are buying a computer, that is an asset. The asset has increased. The cash you are using to buy the computer, that is also an asset, but cash is decreasing. So one asset has increased, the other asset has decreased. So the asset that is increasing is the one that we are debiting. For example, if you buy a computer, you are going to call it computer account and you debit computer account. And then if you have paid by cash, cash being an asset has reduced, so you are going to credit cash or bank account. So here is an example. On 1st March 2025, ABC Limited bought a computer valued at 20,000 and paid in cash. So how do you record that transaction? So you start by outlining or explaining which accounts are involved and which account will you debit and which one will you credit. So first, the two accounts which are involved in this simple transaction, one is computer and the other one is cash. So computer, you did not have a computer before, now you have a computer. So assets have increased. You debit the computer account, which is an asset, and then you had cash before, you had 20,000 before. You have spent your 20,000 to buy the computer, so you no longer have the cash. An asset has reduced. An asset in the name of cash has reduced. So you credit cash account with 20,000. So this one is an outline. This is an outline of how you are supposed to record the transaction. But now we want to prepare the actual account. And this is how we do it. In an account, you're supposed to make it look like a T. We call it the T format. So it separates two sides. The left side is called debit. The right side is called credit. And then on each side you have date, details, and amount. So if it is an asset, first at the top, write the name of the asset. So you're not going to say this is asset account at the top. No, instead, you might have many assets. You might have cash, computer, motor vehicle, equipment. So do not call it asset account. Use the name of that asset. So in this case, we are using the name computer account to differentiate it from other assets the business might be having. So according to our outline, we have said we are going to debit computer account with 20,000. Because you are given the date, 1st March, start with that date on the first column on the debit side. When you go to the details, we normally write the name of the other account which was affected by that transaction. So we have said that this single transaction is affecting two accounts, one computer, the other one cash. So when you are in the computer account, the other account is cash. That is the one you are going to write under the details. And then you write the amount, 20,000. So if you go to the cash account, the title is going to read cash account, but the details you're going to say computer account. So you have the cash account there. Use the same format, the T format. The format is usually the same. So just show the title. The title is cash account. So on the credit side, because cash has reduced, we have recorded the transaction on the credit side. So we said credit cash account with 20,000. Start with the date. Details show the name of the other account, which is computer account. The amount, 20,000. So that is how we record the transaction. It is simple. As long as you start by identifying the two accounts, identify which one you are supposed to debit, which one you are supposed to credit. You can even start with the outline, the same we have done here, and then you prepare the actual accounts. So next, let us see what makes the cost of an asset, in this case a fixed asset. What makes up the cost of an asset? What do we include in the cost of an asset? So the cost of an asset is made up of all expenses necessary to bring the asset to its location and condition ready for use. So if you buy an asset, For example, you live in Nakuru, you buy an asset in Nairobi, the asset is costing 50,000. You have to pay transport from Nairobi to Nakuru, maybe 10,000. And then once you arrive at Nakuru, you have to call a technician to help you to install the asset. You pay the technician. Then you realize there is something that is supposed to be added to the asset to make it start working, to make it operational. Maybe you have to build a small house for the asset. So all the expenses you incur to make the asset ready, to make the condition ready for use, all those should be added to form cost of the fixed asset. So the cost of a fixed asset includes the following: purchase price minus any discount you may be given by the seller, import duties if you are buying from a different country, or other taxes if you are buying within the country, any tax you pay when you are buying the asset, transport or freight charges, the cost of transporting the asset to the business premises, insurance during transport, installation costs, e.g. fitting machinery, wiring equipment. All those expenses are being incurred before the asset starts to be used. In other words, they are necessary for the asset to become operational. You are supposed to add them to the purchase price, and the total is what you call the cost of that asset. But any cost that you incur after you start using the machine, for example, if you have been using it for 1 week and it breaks down and you incur some expenses to repair, the repair cost is not going to be part of the cost. Cost is what you pay before you start using, and it is necessary for the asset to become functional. So here is a simple example. A machine was bought for 500,000. The buyer paid 20,000 extra for transport and also paid a technician 10,000 to install the machine. Determine the amount to be debited in the machine account. So when you go to record in the machine account, you're not going to record the purchase price of 500. Instead, you're going to add the transport cost of 20,000, and also you add the installation cost of 10,000. So the total cost will be 530,000. That is what you will record in the machine account. That is what you will use as the basis for calculating depreciation. Because there is no way you can use the asset if it is not installed. There is no way you can use the asset if it is not in the premises. So any expense you incur to make the asset usable should be added to be part of the cost of the asset. So next, there is something known as depreciation, and you want to see the double entry for depreciation. So first, let us define depreciation. Depreciation is the gradual reduction in the value of a fixed or non-current asset due to its use, wear and tear, passage of time, or other factors. So some of the reasons why assets depreciate. Take something like a building. Building depreciates just by passage of time. If you build a house today, after 10 years you will realize it has become old just because of passage of time. So it is going to lose value. Some assets such as motor vehicles, because you are using them a lot, they will depreciate because of wear and tear. For example, the road where you are driving the car is not very smooth. So some metals may end up breaking. Some parts may become loose. So machines usually depreciate due to wear and tear. So we have many other reasons, including obsolescence. A computer will depreciate because it becomes outdated. The computer you bought 10 years ago, right now, it is very cheap. If you are to sell it, it is not broken. The screen is still very good. The rest of it is still very good, but you cannot sell it at the price you bought it for because we have modern computers which are more better. So obsolescence is another reason why assets depreciate, especially because of changes in technology. So when a business provides for depreciation, these are the entries you are supposed to make. Debit depreciation expense account, credit accumulated depreciation account, which is also known as provision for depreciation account. Those are the primary entries. For the depreciation expense account, we normally record it for 1 year. For the accumulated depreciation account, it is taken to the next year and the next year and the year after that. In other words, it usually has a balance carried down, which is taken to the next year, and you are going to keep that account as long as the asset exists. But for the depreciation expense account, it is just a 1 year account. In the types of accounts, depreciation account would be called a nominal account or a temporary account. You only keep it for 1 year. But for the accumulated depreciation account would be a real account. It is permanent. You will have it as long as you have the asset. So what do we do with the depreciation expense account at the end of the year? Because we have said it is temporary. In the second point, this is what we do. These are the entries made at the year end. You are going to debit profit and loss account, and you're going to credit depreciation expense account. So look at what you have done in number 1. You have debited depreciation expense account. And then in number 2, you have credited depreciation expense account. So what will happen is that the debit side will balance out with the credit side, and you will not have a balance to be taken to the next financial year. So at the end of the year, everything in the depreciation expense account is normally taken to the profit and loss account. You close that account. In the next year, you will have a new one. But for the accumulated depreciation account, you will be carrying the balance forward to the next years until maybe you dispose the asset. That is when you will close that account. So we have methods of calculating depreciation. We have 3 of them. We have the straight line method. We have the reducing balance method, which is also known as actuarial method. We have sum of the digits method. We are going to be looking at these 3 methods, starting with number 1, the straight line method. So first, we want to understand what is a straight line method. This is a method where depreciation is spread evenly over the useful life of the asset. So if the asset is going to be useful for 5 years, you are going to divide the cost of the asset with 5 years. That is going to give you depreciation per year, which is going to be the same amount. If the asset has a salvage value, the salvage value is how much you can sell the asset for. If the asset can be used for 5 years, it may have some remaining value. You can still sell it at a very small price, which we call the salvage value, also known as the scrap value. So you take the cost of the asset, you deduct the salvage value, then you divide by the useful life of the asset. That is the amount for depreciation in each year. So this one is a very simple method because the depreciation you get for year 1 is going to be the same as the depreciation for year 2 and any other year that follows until the asset is disposed. So we have two ways you can find the depreciation using the straight line method, depending on what you are given in the question. If you are given the salvage value and the useful life, then the first formula is the one you are supposed to use. If you are given the depreciation rate, but you are not given the useful life, you are not given the salvage value, then you can use the second formula. You just take the depreciation rate and multiply by the cost of the asset. And then the depreciation is going to be constant throughout. So that is how we apply the straight line method, and it is very easy, even compared to the other ones. So let us now look at the next method, which is the reducing balance method. So in this method, the amount of depreciation reduces as time passes. So there is higher depreciation in the early years and lower depreciation in the final years. So the formula we use is shown here. Depreciation is equal to depreciation rate times, in brackets, cost minus accumulated depreciation. So the items inside the brackets, that is the cost minus accumulated depreciation, they are also known as book value. That is how we find the book value, which is also known as the carrying amount. So if you take the book value, you multiply by the depreciation rate, you are going to get depreciation for the year. Unlike the previous method, in this method, depreciation is not going to be constant. In year 1, you will have a higher amount. In year 2, a different amount which will be lower, because the remaining balance is less. The value of the asset reduces with the time. And we normally take the rate, you multiply by the remaining value of the asset. So here is a simple example. A company purchased a machine at a cost of 100,000. Depreciation is to be provided at the rate of 10% on reducing balance method. Calculate depreciation for the first 3 years. So we have the solution. So we go 1 year at a time. We start with year 1. In year 1, you will notice that we don't have any previous depreciation. So this is the first time for you to provide the depreciation. We don't have accumulated depreciation. Therefore, you are just going to multiply the cost of the asset with the rate of depreciation. 10% times 100,000, which will give you 10,000. So when you go to the second year, now that you have previous depreciation, that is for year 1, you're going to change a bit. You're going to take the depreciation rate multiplied by, in brackets, original cost of the asset minus the previous depreciation. We only have depreciation for 1 year, which is 10,000. So when you deduct 10 from 100, you get 90. And then you take 10% of 90, it gives you 9,000. That will be depreciation for year 2. Then when you go to the third year, now you have depreciation for 2 years. The accumulated depreciation is the depreciation for year 1 plus the depreciation for year 2. In year 1, we have 10,000. In year 2, we have 9,000. So total is 19,000. So in brackets, you take the cost you minus accumulated depreciation. 100 minus 19 will give you 81. Then you take 10% of 81, it will give you a depreciation of 8,100. So that is how we apply the reducing balance method. A bit complicated than the first one, but still not that hard. We go to the third method for calculating depreciation called sum of the digits method. Sometimes we call it rule of 78 method. So it is a method of calculating depreciation where higher depreciation is charged in the early years of the asset's life. Smaller depreciation is charged in the later years. Somehow similar to the reducing balance method, but not exactly the same. So the idea is that an asset is more useful or more productive in its earlier years and less efficient later. So let us follow the steps here in order to understand it better, how it works, how sum of the digits works. Number one, find the total of the digits of the asset's useful life. Example, if you are given that the useful life is 5 years, add the years. We have year 1, year 2, year 3, year 4, year 5. Add those digits. So the years are the digits. Add those digits. The total will give you 15. That is step 1. Step 2. Assign fractions to each year using the remaining life divided by the total sum of digits. So when you go to year 1, what is the remaining life in terms of years? The asset has 5 years to go. So take that 5, divide it by sum of the digits. When you go to year 2, how many years are remaining? 4. So take that 4, divide by 15, sum of the digits. You do the same with year 3. Remember, in each year, it is going to be reducing, the useful life is going to be reducing by 1 year, but the denominator is still going to be constant, which is the sum of the digits, in this case 15. So in year 1 it was 5, in year 2, 4, in year 3, 3, in year 4, 2, in year 5, 1. Then you divide by, each one you are dividing by the sum of the digits. So in other words, the fraction you have here is the rate of depreciation that you are going to use. So therefore, in sum of the digits, you can say the rate of depreciation is different for each year. In the reducing balance, the rate is the same, but the remaining balance changes. In sum of the digits, the rate changes, but the cost is constant. You are going to be multiplying the rate with the same figure because the cost is not changing. So look at step 3. Multiply each fraction by the depreciable amount. The depreciable amount is usually the cost, but if you are given the scrap value, which is also known as the salvage value, the depreciable amount is cost minus scrap value. So when you take the fraction, you multiply by the cost, it gives you the depreciation expense for the year. Look at this example. If the cost of the asset was 100,000 and we use the same useful life for 5 years, what will be the depreciation for year 1? Take the fraction for year 1. The fraction for year 1 is 5 over 15. Multiply it with the cost, which is 100,000. Depreciation for year 1 will be 33. So what about year 2? Take the fraction for year 2, multiply it with the original cost. Depreciation will be 26. 667. In other words, the rate changes from one year to the next, but the basis or the amount you are multiplying does not change. So in each year you are multiplying by the cost, 100,000. You just use a different rate. So that is sum of the digits. So next, we want to see the double entry for asset disposal. Although fixed assets, you don't buy them with the intention of selling them, it reaches a point where a business wants to replace an asset with another one which is perhaps better. So they have to sell the old asset. Or maybe they no longer need the asset, so they have to sell it. Sometimes they can sell it at a higher price and make a profit. Other times they can sell it at a throwaway price and make a loss. So whenever an asset is being sold, we normally open an account known as disposal account. And in that disposal account, these are the entries we normally make. The first one, when a business sells an asset, debit disposal account. With what amount? With the original cost of the asset. Not the cash you receive. Not the cash you receive, but how much you paid when you purchased the asset. And then credit asset account with the same amount, that is the original cost of the asset. So that is the first entry. The next one, with cash received on disposal. So when you receive cash, debit cash account. If you receive a check, then you are going to debit bank account. And then you are going to credit disposal account with the same amount, which is the cash you have received. The third one, with accumulated depreciation on the asset disposed. The accumulated depreciation for all the previous years since you purchased the asset up to the time when you are selling it. All that depreciation, you are going to debit accumulated depreciation account, then you credit disposal account. The first three are the primary entries you are supposed to make in the disposal account. The last part is just the balancing figure. So after you have recorded the cost of the asset, cash received, accumulated depreciation, look at the difference, the debit side versus the credit side. Where is the balance going to? So with the balancing figure on the disposal account being the profit or loss on disposal, this is how you are going to account for it. If the balancing figure is on the debit side, then it is a profit. So if it is a profit, then you debit disposal account and credit profit and loss account. But if the balancing figure is on the credit side, then it is a loss. If it is a loss, you are going to debit profit and loss account and credit disposal account. Those are the entries for asset disposal. But you want to see the account to make it easier to understand. Let us look at the disposal account. So this is the disposal account. It is just a summary of what we have seen. So we have said, first, the cost of the asset. When an asset is disposed, we debit disposal account, we credit the assets account. That is why on the debit side of the disposal account, we have written here asset account, because the other entry will be taken to the asset account. So the amount is original cost of the asset being disposed. So what about depreciation? We have said with the amount of accumulated depreciation, debit the accumulated depreciation account, credit asset disposal account. So that is why on the credit side of the disposal account, we are recording the accumulated depreciation of the asset being disposed. When you go to the depreciation account, the provision for depreciation account, it will be on the other side, which is debit side. So what about cash received? We have said with cash received, debit cash or bank account, credit disposal account. So that is what we are doing here. We are crediting disposal account with the sales proceed. What we receive? Cash received on asset disposal. Those three are the ones you are supposed to record. The rest of it is the balancing figure, which can be on either side. So compare the debit and the credit. If the credit side is higher than the debit side, the balance will be on the debit side, and we are going to call it profit on disposal. That is the balancing figure. But if the debit side is higher than the credit side, the balance will be on the credit side, and we are going to call it loss on disposal. That is the balancing figure. That is the disposal account. As long as you remember the format, it is very easy to calculate profit or loss on disposal. So now let us see the format for asset account, because we are going to be preparing this one in an example. So this is the format of an asset account divided into two sides, debit and credit. Let us start with the debit side. Assuming a business is starting a new year, you are supposed to bring the assets they had in the previous year and debit. You call it balance brought down. Cost of the assets at the year beginning, which is what the business had at the end of the previous year. And then during the year, the business may purchase an additional asset. If the business does that, you are supposed to debit the asset account. Remember what we said, increase in assets, we debit. So if they buy, maybe they pay by bank, you are going to write here bank account, because when you go to the bank account, you are going to credit it and call it asset account. The amount is cost of purchasing a new asset. The only thing we record on the debit side is acquisition of the asset. Then when you go to the credit side, we record disposal of asset. If the business sells an asset during the year, you are going to credit the asset account, because we said decrease in assets, we are supposed to credit the asset account. So you're going to call it disposal account, because this amount will be taken to the disposal account on the debit side. This is supposed to be the original cost at which the asset being disposed was purchased. Not what you are receiving as cash, but the original cost. So those are the only three items you are supposed to record in the asset account. So as you have seen, the asset account is maintained at cost. It is very important that you remember that the asset account is always maintained at cost, not the net book value. In this system you are using, it is maintained at the cost. So once you have recorded the three, you just have now to calculate the balance carried down, which is now the assets you have at the end of the year. We call it balance carried down. And when you go to the next year, you are going to start with it as your balance brought down. So that is the asset account. Let us go now to accumulated depreciation account. So accumulated depreciation account is usually the one required in an exam, unlike the depreciation expense account. So remember for depreciation we said we have depreciation expense account, which is temporary, and we have accumulated depreciation account, which is permanent. So in most cases in exam, they ask you to prepare the accumulated or the provision for depreciation account and not the depreciation expense account. So we normally record the increase on the credit side. Increase in depreciation we credit, decrease we debit. So let us start with the credit side. Because this one we said is a permanent account, it is taken from one year to the other. At the beginning of the year, you are going to bring the previous balance from the previous year and call it balance brought down, which is accumulated depreciation from the previous years. Before you even start calculating depreciation for this year, bring the previous balance. It is called balance brought down or balance brought forward. From there, now calculate depreciation for the current year, which will be debited in depreciation expense account. So you're not going to write here profit and loss account. No, because we said the other account being affected is depreciation expense account. That is why we are writing here depreciation account, representing the expense account, which you said is a temporary account. So this is the depreciation expense for the current year. So it is an increase in depreciation we credit. So now we go to the debit side. The debit side, we only record if the business disposes an asset. Take the accumulated depreciation of that asset, you debit this account, and you are going to call it disposal account, because once you open the disposal account, you are going to credit that account with the same amount you have here. So here you debit, in the disposal account you credit. So this is the accumulated depreciation of the asset being disposed. So we only have those three items here. The rest is just the balancing figure. Balance carried down. At the end of the year, you are going to do the additions, the subtractions, and record the balance carried down here, representing the accumulated depreciation, which is to be taken to the next year. So once you go to the next year, this balance carried down will be on the credit side as the balance brought down. So that is the accumulated depreciation account. And now we have an example. We are going to use this example to help us to demonstrate how to prepare each of those accounts. There are only three important accounts that we need to prepare. Those are equipment account, this is asset account, provision for depreciation on equipment account, and the disposal account. So those are the only relevant accounts. We are not preparing the profit and loss, the depreciation expense account, the cash account. We stick to the relevant ones. So let us go through the example. It says Rosa Limited has the following transactions relating to its equipment. The year 2022, January 1st, bought equipment A and B for 180,000 each. 2023, January 1st, bought equipment C for 400,000. July 1st, bought equipment D for 200,000. 2024, January 1st, sold equipment A for 95,000. Then below that, you are told that the firm depreciates equipment at the rate of 20% per annum on cost. So this is what you are supposed to do. One, for each of the years ended that 1st December 2022, 2023, and 2024, prepare equipment account, provision for depreciation on equipment account. Also, for the year 2024, prepare equipment disposal account. So one thing I would like you to note here is something to do with the dates. Dates are very important. You are given the date of purchase here. You are given the date of disposal here. So look at the one for 2023, July 1st. So if this asset was purchased on July 1st, how are you going to calculate depreciation? Because the year is supposed to end on that 1st December. You have purchased the asset on July 1st. So you have been with that asset for 6 months to the end of the year. So because you are not given any policy that the company uses, in some cases you are told to use a full year depreciation in the year of purchase. But we are not given any policy here. So we cannot provide depreciation for a whole year if the asset was purchased in between the year. So because these are going to be 6 months, depreciation will be 20% of 200 multiplied by 6 divided by 12. So another thing, what method of depreciation are we required to use? So we are given 20% per annum on cost. So if you are told it is on cost, that is automatically a straight line method. If you are told it is on carrying amount or net book value, that is automatically a reducing balance method. So because this one is a straight line method, it means depreciation for 1 year will be the same as depreciation for the next year and the next one and the next one and so on. Which means it is a bit easier because once you have depreciation for A for year 1, you are going to use the same one for year 2 and the same one for year 3. So another thing I want you to be keen on is the disposal of A. So A has been disposed on 1st January 2024. So how many years has A been depreciated? Look at the date of purchase, 1st January 2022. So depreciation for the whole of 2022, that is 1 year. Depreciation for the whole of 2023, that is a whole year. But when you go to the last year, 2024, we cannot say that the asset stayed in the business in that year because they disposed it at the beginning of that year. So therefore for asset A, we are going to have depreciation for just 2 years, 2022 and 2023, but not 2024. So that is what I want you to keep in mind as we go to the preparation of the accounts. So A was disposed for 95,000. That is the cash that was received. That is the cash that was received when A was disposed. So A had been purchased at a price of 180,000, but it was disposed for 95,000. So was that a loss or a profit? We cannot be able to tell until we prepare the disposal account. So let us start with the first one. The first one is equipment account. So in the equipment account, you are going to notice that in the first year, we will have equipment A and B as being purchased. In the next year, we will have equipment C and D as the one that were purchased. So here we have the equipment account. So this is the correct format in such a question. So always divide it in terms of years, because we were told for the years ending that 1st December 2022, 2023, 2024, you are supposed to prepare for each year separate. So let us start with the first year, 2022. So remember what we said. First, look at the format we have. We have the debit side, we have the credit side, we have the name of the account. The name is equipment account, which is an asset account. And then we are supposed to show three things: the date, the details, and the amount on each side. So if you look at each side, we have the dates, we have the details, we have the amounts. So we said increase in asset, we debit the asset account. Decrease in asset, we credit the asset account. In the year 2022, the company did not have a balance brought down. So they started buying the assets in that year, and it was on 1st January. You were told that they purchased equipment A and B for 180,000 each. So it is good to show each one separately. So we have equipment A 180,000, equipment B 180,000, and then in the details we have written here bank account, because cash is going to be obtained from bank. So it is unlikely that they are going to be buying this equipment by paying cash in hand. So most likely they are going to pay through the bank. In the question it was not clear, so we just write bank account, because when you go to the bank account, you are going to credit. You're going to credit the bank account. So here we debit the equipment account and call it bank account. There was no other transaction that took place in the year 2022. Those are the only assets that were purchased. There was no asset that was disposed in that year. So by the end of this year, calculate the balance carried down, which is the two you add 180 plus 180, giving you 360. So by the end of the year, that 1st December, the balance carried down will be 360,000. So add the two sides, they will give you 360, and then you underline using two lines, you close the year. So when you underline using two lines, you are closing that year so that you can proceed with the next year. So let us now proceed to the next year, 2023. So in the year 2023, before you record any transaction that took place in that year, bring the balance from the previous year first. In the previous year, we had a balance carried down of 360,000. Bring that amount to the next year on the opposite side and call it now balance brought down. You're going to bring it at the beginning of the year before you start recording any other transaction for that year. So remember, in the question, in the year 2023, the company purchased two more equipment, C and D. C was purchased for 400, D was purchased for 200. So we debit increase, because assets have increased, we debit, and we call them bank account, just like we did previously. Because the money will come from the bank, we are going to credit the bank account. In the year 2023, there were no other transactions, no more acquisitions, no more disposals, just C and D. So by the end of this year, by that 1st December, the balance carried down will be the total of what you have on the debit side, 360 plus 400 plus 200, which will give you 960,000. So record the totals for both sides, close the year, and proceed to the next year, which is 2024. So again, before you look at the transactions for the year 2024, start by bringing forward the balance from the previous year. So the previous year is 2023, the balance carried down was 960. Bring it to the year 2024 on the opposite side, and it will be at the year beginning, 1st January. Balance brought down 960,000. So once you have recorded the balance, now look at the transactions that took place in the year 2024. In the question, there were no purchases, but there was a disposal of equipment A at a selling price, at a sales price of 95,000. So once you dispose an asset, we say the assets have decreased. Once the assets decrease, you credit the asset account. So on 1st January, that is the date when equipment A was disposed. You record disposal account because this amount will be taken to the disposal account on the debit side. So in brackets, you have to specify which equipment we are disposing. So this is equipment A. The amount we are recording here, remember, is supposed to be the original cost of A. If you go back to 2022, you will see that equipment A had costed 180,000. So when we dispose A, we are eliminating 180,000 from this account. Now we don't have equipment A anymore. We have taken how much we had recorded initially and we have eliminated it, which means the value that is going to be left here is for all the other assets without A, the cost of the remaining assets. So we don't record the sales proceed here, just the cost. All entries in the asset account must always be at cost, not the net book value, not the sales value, just cost. That is called a historical cost concept. In the introduction to financial account, we have the accounting principles and concepts. One of them is called historical cost concept, which says that assets should be recorded at the historical cost, which is the cost of purchasing the asset. So we don't adjust them for other things unless in the case of revaluation, which we are not looking at in this case, unless in the case of revaluation we debit, but that is a topic for another day. So in other words, we don't record them at net book value, we record them at cost. So in the year 2024, after you have disposed A, the balance you are left with is 780,000. There were no other transactions in this year, no acquisitions, no other disposals, and that is how we prepare the equipment account. Very easy. So next we have provision for depreciation on equipment account. So this one is a bit complicated than the previous one. The provision is usually harder, especially if you are told to use the reducing balance method. So this one is a bit easier because we are using the straight line method, where depreciation is just constant throughout. So let us start with the first year, 2022. So one thing you should note, in provision for depreciation account, whenever we charge depreciation, we credit. We don't record anything on the debit side unless you have disposed an asset. We don't debit. The increases, the charges for every year, we always credit. That is one thing you should note. The other thing, you may have to separate the individual assets. If you are calculating depreciation, don't calculate depreciation for all assets as one figure. Separate asset A from asset B, from C and D for easier workings. Also, if you dispose one of the assets, it will be easier to add up the depreciation for the asset being disposed. So in the year 2022, at the end of the year, you are going to charge depreciation. So here we are writing depreciation expense because we said, according to the double entry, we normally debit depreciation expense account and credit provision for depreciation account. So remember the rate. The rate was 20%. And the cost of A and B was 180,000. So what is 20% of 180,000? It will give you 36,000, and that is what we have recorded here. Depreciation for A for the first year will be 36,000. Depreciation for B for the first year it will be 36,000. And then because we only have the two assets in the first year, by the end of that year, we are going to calculate the balance carried down, which is 36 plus 36, giving us 72,000. And then we are going to close off that year. We proceed with the next year, which is 2023. So, you're supposed to develop this habit before you start making transactions in the current year. Start by bringing the previous balance in the previous year to the current year. So the balance carried down of 2022 is supposed to be brought to the year 2023 on the opposite side. If the balance was on the debit side, you bring it on the credit side of the current year. And then you call it balance brought down. And you are bringing it at the beginning of the year before you record any other thing. So it was 72,000, and that is what we have here. So during the current year, which is 2023, so this is why it gets a bit complicated, because you are supposed to provide depreciation for each asset you have. Remember, in the previous year you purchased A and B, and then in the current year you have added two more, C and D. You are going to provide depreciation for the current year for each asset that you have. You still have equipment A, so the good thing is that the depreciation that you had in the first year for A is still going to be the same for B. Because we're using the straight line methods, the depreciations don't change. Each year you have the same amount. So provide for A, that's 6,000. Provide for B, that's 6,000. But now you purchased a new asset called C. The original cost for C was 400,000. So take the depreciation rate 20%, multiply by 400,000. So you will find that you will get 80,000. And because C was purchased on 1st January, depreciation is going to be provided for the whole year. But when you go to D, I said the dates are very important. D was purchased on 1st July. And it was purchased for 200,000. That was the cost. So because the asset stayed for 6 months to the end of the year, we are supposed to charge depreciation for 6 months only. So take the rate, which is 20%, multiply by the cost, which is 200,000. That will give you 40,000. And then you divide by 2 because it is for half a year. So you will get 20,000, which is what we have here. So we have provided depreciation for each asset the company had in this year. At the end of the year, because there is no disposal, we are going to calculate balance carried down, which is 244,000, which is the total for all these figures from balance brought down to all this depreciation expenses. So let us go to the next year, 2024. Again, before you record anything else, bring the balance from the previous year. So in the year 2023, the balance carried down was 244,000. So bring it at the beginning of the year, which is 1st January, and call it balance brought down 244,000. Again, calculate depreciation for each asset the company has in this year. So remember what we said about company A? Because it was being disposed on 1st January, we cannot calculate depreciation for it for the year. So we are left with equipment C, we are left with B, C, and D. And because we are using the straight line method, the figures are not going to change. So we use the same depreciation that we had for B in the previous year, that is 6,000. For C, it was 8,000. We still have the same because the amount remains constant. But when you go to D, in 2023, D was purchased in between the year. But when you go to 2024, equipment D has stayed for a whole year, 12 months. So we are calculating depreciation now for a whole year, not half a year. So the cost was 200,000 for D. 20% multiplied by 200,000 will give you 40,000. So that is the correct depreciation expense for D for the year 2024. Then on the other side, in the question you are told that equipment A was disposed on 1st January. So when an asset is disposed, we are supposed to eliminate depreciation for that asset from the provision for depreciation account. So how much have we provided so far for equipment A? If you go to the first year, 2022, equipment A depreciation was 36,000. The next year, 2023, equipment A depreciation was also 36,000. We only provided depreciation for A for 2 years. 36 you multiply by 2 will give you 72. So 72 is the accumulated depreciation for equipment A. So therefore, we are going to eliminate all the depreciation for A by debiting this account. And we are going to write here disposal account, because when we go to the disposal account, we are going to credit and call it accumulated depreciation, 72,000. And it was on 1st January. So by the end of 2024, add the expenses for the current year, start with the balance brought down, add the expenses for the current year, deduct disposal, the balance carried down will be 328,000. So that is how we prepare provision for depreciation on equipment account. So in the exam case, the only thing that can make it a bit complicated is the method you are told to use. If you are told to use the reducing balance, obviously it will be a bit challenging than this one, because in this one the figures are not changing. However, the important thing is to know which side you're supposed to record, and the procedure. The procedure is the most important thing. So let us now go to the disposal account. So it is only for equipment A, because A is the one that was disposed. So let us start with the debit side. The debit side, remember in the equipment account, on the credit side, we recorded 180,000 and in the year 2024. So that is the same figure as what we have here. So, and then we have written here equipment account. Reason being, the other amount was credited in the equipment account. It must be the original cost of the asset, 180,000. That is how much A was purchased for. Then on the other side, record the accumulated depreciation for A. In the previous account that we have just prepared, provision for depreciation account, we have seen that the accumulated depreciation for A is 72,000, and we have debited that account, and we have called it disposal account. Now that we have come to the disposal account, we call it provision for depreciation account, because that is where we got the figure from. So because in the provision for depreciation account we debited, here we credit. We record on the opposite side because we are using double entry system. So remember, in the question, cash received on disposal was 95,000. When you receive this cash, you are going to debit your cash book. You are going to debit your cash account or your bank account. Because you have debited there, here you credit. So you credit, you call it cash account, and this is the cash received on disposal, 95,000. Those are the only ones you record. The other one is just a balancing figure. So look at the cost, 180, compare it with the amounts you have on the credit side, 72 plus 95. So which one is more? The cost is more. 180 is higher than 72 plus 95. So that makes the balancing figure a loss. We said if the balancing figure is on the credit side, it is a loss. So the balancing figure is 13,000. It will be taken to profit and loss account. If it was a profit, it would have been on the other side. It would also have been taken to the profit and loss account. So that is the simple way in which we prepare the disposal account. So I hope by now you understand how to account for fixed assets. But we have other assets that we have not looked at. We have assets like accounts receivable, where we normally have something like bad debt allowance for doubtful debts. We have another asset like cash, where we normally open a cash book, we prepare bank reconciliations, and so on. So this is accounting for asset part 1. In part 2, I'm going to be looking at mostly the accounts receivable. So that is the end of the lesson. Thanks for watching.